Yeah, good morning, good afternoon, depending where you are in the country. Thank you for joining us today at this IDC webinar on My Par Gift. For those of you who don't know me, my name is Nitin Bansal. I am the Director of Actuarial Support at IDC Win. And it is my honor, my pleasure to introduce Evan Connell today, the Director of Insurance Sales Strategy, PAR from Canada Life. For more than a decade, Evan has worked in several sales roles, including Life Manager and Sales Consultant for Canada Life, focused on life insurance, living benefits planning. His territory spanned across Central Ontario, providing support for advisors focused on insurance planning. He currently helps to create innovative insurance tools and sales strategies to support wholesalers and advisors across Canada in having important financial, estate, and legacy planning conversations with clients. Evan, I will pass it to you, and you can take it away.
Perfect. Thank you so much, Nitin. I appreciate the time from everybody today, and good morning and good afternoon to everybody across Canada. Really excited to speak to everyone about the launch of Canada Life My Par Gift. As it so happens, I was a bit late to join the backstage before this meeting, and the reason for that was I was in a conversation with one of the leading charities across Canada, positioning My Par Gift with them. And really, our focus before I step through the deck with those folks has been around education and awareness. And I'm going to touch on a few points relating to that on insurance in the past within the charitable space in particular has come with what we'll speak to in a few slides, baggage, particularly with complexity, ongoing premium commitments, a lot of kind of challenges or friction from a charity's perspective. And we're going to speak to today really how Canada Life My Par Gift has changed that dynamic, changed the conversation, and introduced a new story to position insurance specifically in the charitable space. But really had a successful call. We're about a month in post-launch, and really we've had a tremendous amount of positive feedback around the launch of My Par Gift. We've had leading charities across Canada reaching out to us directly. So we've been very much reactive over the last month. And where I'm excited to be in front of this group is we have a new conversation for you to have with your clients, philanthropic clients, or just clients in general, to have conversations around insurance planning and potentially where this solution could fit amongst their financial plans. So for today, I'm going to step through a few slides, and I believe as Nitin had spoken to, these slides will be made available to everyone. But really, the excitement is I'm excited to be here with you today to speak to the launch of Canada Life My Par Gift. The 3 points on the screen are really the 3 pillars that were used in the development of this solution. Nitin gave a bit of my background around, I come from the sales strategies team at Canada Life. Over the last 2 years, I've been seconded almost to the development of My Par Gift. And those 2 years have really been focused on generating feedback with various stakeholders, which we're going to speak to. And those stakeholders, though, they were gift planners. So these are individuals that specialize in the charitable space to give us very honest feedback on what are the limitations with existing traditional insurance that are used for traditional planned gifts. Also working with significant associations, Canadian Association of Gift Planners as well, one of the leading associations of like-minded individuals focused in the charitable space. They were a driving force towards the development of this solution too. The other piece over the 2 years was direct connection with charities. We had them under NDA, really to provide us with feedback. And the reason I have these 3 pillars in front of us right now is that feedback has really driven these discussions. Number one was the need for innovation, the need to develop a solution, and really where we're excited is the fact that this product is Canada's first insurance product that's designed around the needs of donors and of charities. It is a single pay participating life insurance policy. That's the punchline. You're going to hear me say that probably at least 20 times on the call today, but it is participating life. So it is a single donation or deposit or premium, but it is par, and that it has the same benefits as par. It has cash value, which we're going to take a look at, as opportunity for growth. It has paid up additions. It has enhancement. It has cash dividend options. We're going to look at how this can be attractive for a charity and for a donor. But this is, again, the first product in Canada that's only available at Canada Life that is designed around the needs of charities and of donors. And that's why we're getting so much excitement from charities and from gift planners around the launch of this solution. The simplicity piece, pretty straightforward, single pay, single deposit, product is literally paid up after that single deposit takes takes place. There is no ability to put additional premiums into this product as it stands right now. See, that's a point that we're taking feedback on. We've heard from a number of folks that they'd like to have a bit more flexibility, but as it stands right now, the value proposition is literally a single deposit. And where that becomes very important is when I'm touching on in a few moments the feedback that we heard from charities on traditional insurance and ongoing premium commitments and the challenges or friction that that can provide is significant. And the fact that this is a single deposit is something that's very attractive. And again, one of the drivers behind the excitement here. The other piece is it's all fine and good to have a great product that launches. Another significant piece of feedback that we received was on the servicing experience, the fact that it should be tailored to the needs of charities. And prior to the last 2 years, as Nitin had spoken to myself, I was traditionally positioning and participating life insurance or just insurance in general to individuals and to corporations. What we heard loud and clear is the products and also the servicing proposition that we provide is designed around individuals' needs and not charities. And the reality is charities are not insurance specialists. We've put significant efforts into how do we make that a more favorable experience for charities. And already in the conversations, we've onboarded about 20 of the most significant charities across Canada that you could think of. And that onboarding has been opportunity for partnership. Let us know if there are pain points that you're experiencing. We've done our best efforts to really provide as best an experience as possible, but also want to recognize if there are gaps or limitations that we have open dialogue with them. But from what we've discussed with them, lots of excitement around the launch of this solution and really the servicing proposition that it provides. But an important point that it isn't just a new product. We've taken our efforts to make sure that it is a positive value proposition as well from a servicing perspective. But what I want to do is just take a bit of a step back before I jump into the product. It's really want to set the stage around what plan giving is, because it's really important to appreciate the market for this product that has been developed and to understand where the product fits. Plan giving as opposed to cash giving, and that's really what people would traditionally think about when they're thinking about making a donation. That's usually at the end of the year, or maybe it's something on their payroll. Cash gift is what traditional people would be looking for. Plan gifts, though, are really around structured long-term strategies to donate. So a few elements that distinguish plan giving from basic charitable giving is, number one, it's in the name, planned, forethought of providing some sort of substantial gift through the lifetime or at death. Number two is it's structured, and this is an important point. So it uses some sort of financial vehicle to support the gift, whether that be a donor-advised fund or a DAF, insurance, a bequest on a will, some sort of vehicle to maximize or leverage the impact, so to increase that impact. And number three, and this isn't changing with this product, this is a highly advised process. And that's something that I've had to make loud and clear when we are positioning this solution with charities. This is something where the donor is at the table, the advisor is at the table, and the charity is at the table when we're having conversations around what is the goal of this solution and where does it fit within the overall financial and estate planning of the individual. But essentially, to summarize, it's the whole market built around the plan giving. And I'm going to get into on the next slide, really, some of the key points, some opportunities that are available in the charitable space. So quite a bit of information on this slide here, but some of you really may already be working in the charitable space, while others may not have it on their radar right now. So we're confident that this product is an opportunity to develop a new market where one doesn't quite exist to its potential yet. I draw your eyes on the screen to the big zero at the bottom under life insurance. The number of insurance products focused on the charitable giving space today, there are none. So I already spoke to that when I talked about the excitement of what we're looking at launching, is the fact that this is a kind of a first in Canada, only available at Canada Life. Where we get excited, though, is from when we're looking at donor advised funds. So what a donor advised fund is, for those that aren't familiar, it's a plan giving vehicle. Essentially, it's a charitable gift wrapped in an investment product. You provide a donation, you open up a donor advised fund account or a DAF, you decide how you want to invest, you get a tax receipt, and you decide which charity you want to distribute that money to. What's important on this screen is you can see from 2006, from $1.2 billion to the projected growth of about $6.5 billion. And I was just recently, a few weeks ago, out in Vancouver at the Canadian Association of Gift Planners annual event to launch My Par Gift, and they were looking at even higher numbers than that. So there is significant growth in the plan giving space. The reality is there are no insurance products or very little traction. That's that 2% in the bottom left corner. The percent of donor advised funds that are funded through insurance is a very, very small percentage. and the number of assets is very small. So what we're looking to do with the introduction of this solution is to change that dynamic, to change the conversation. But the question is, why has there been so little traction with life insurance in the charitable space? Because we all know, being advisors, financial planners, we understand the great value and power behind what insurance can provide from a financial planning perspective. But why hasn't it gotten the traction with individuals and they're looking at making donations? So let's take a look at what was the feedback that we received over the last 2 years in the development of the solution. Number one, this is broken down into advisor feedback and charities. Number one is, from an advisor perspective, it's the adage of fitting a square peg into a round hole. The products that exist currently in the marketplace today, I spoke to it before, they're designed around the needs of individuals and corporations. They're not designed around the needs of charities and of donors. Number one reason for that is ongoing premium commitments. Individuals and corporations are looking for more flexibility in how they can fund a product. Whereas for this solution that we're looking at today is a single pay product. So number one piece of feedback we received, whether it be from charities or from advisors, is specifically that ongoing premium commitments are a challenge, they're a friction point, and they need to be addressed. Number two, from an advisor perspective, the financial underwriting process, to say the least, is challenging. And I'm going to speak to how we've enhanced that experience through My Par Gift. The other piece is servicing in-force policies is, again, as I said before, to say the least. I've heard this for the last nearly 2 years around how challenging servicing in-force policy is from an advisor perspective, but also from a charity perspective, because as you can appreciate, charities are not insurance specialists. And they require some additional support for that. And that was one of the key pieces that we took away. How can we make this servicing proposition as favorable as possible? Other key point is insurance products. We live and breathe insurance every day, but they come with complexity. And the call I just came off, I saw a few of the key individuals in the philanthropic area at this particular charity. You could see their eyes light up around complexity. You could see that they have stories that they wanted to share, and they did share them with us around the complexity and also specifically the premium commitments. But the premium commitment point, just to tell a little bit of a story, is, again, as you can appreciate, whether it be participating life insurance products that they assume might be paid up, but in fact they're on offset, dividend scale adjustments can occur, then ongoing, there might be an additional need for more premium to be paid. Universal life contracts is another one that we heard quite a bit when we were looking at doing research. So an aggressive interest rate assumption that the policy needs to achieve to keep paid up. They're not able to achieve that rate. As a result, additional premium is required, and the charity stuck either going back to a donor who might be quite a bit later on in their life, asking for additional money to fund the policy so it doesn't lapse, or the charity needs to come up with the money themselves. So it's a significant pain point, and that's one of the biggest servicing challenges with the solution. And kind of to give you a bit of a window on, from a servicing perspective, how we've made My Par Gift more favorable for the charity is the fact, and I will say it many times, I think I've already said that already, but the fact that it is a single premium product that addresses that pain point around ongoing premium commitments head on. There is no circumstance where we would ask for additional premiums. But let's step through My Par Gift. Let's look at product design, look at some numbers as well for illustrations. Let's look at how it differs from our existing product shelf. And then we're going to take a little bit of a deeper look into some of the tax implications, how receipting works, whether it's not specific to My Par Gift, but just for awareness. Again, myself, 2 years ago, if you're asking me for all the specifics around receipting, I wouldn't have known that. Now, over the last 2 years, I've been given the opportunity to educate myself on that, but wanted to take a moment to go through that. The other piece is to look at 2 case studies and see how this can actually work for a client as well. So product design, I'm going to step through the mechanics. We're all familiar with participating life insurance. A couple key points on here. So traditional PAR has ongoing premium commitments. We heard about that pain point. This product is a single premium product. Single deposit is made, policy is literally guaranteed paid up. How we were able to achieve that is the fact that this product is not exempt from taxation. Traditional insurance products are designed to fit within CRA's rules around the growth maximums that you can have within a product. This is designed to be non-exempt. And that's a key point. 2 key points on that, actually. Number one, question that we get commonly is, well, is this product just built on our early value, our wealth achiever, or our estate achiever chassis? It's not. The product was designed to take advantage of the fact that it is non-exempt. So it's a unique solution that's on our product shelf. And you'll see when you look at the illustration comparisons that the death benefit and cash value growth that's available through this solution surpasses every par product that's on our shelf right now. And when you're comparing it against our leading competitors, Sun Life and Manulife, looking at their delayed value products, you'll see that death benefit and cash value, we have a fantastic story there. We're very competitive. And again, the key point to take away is this product was designed around the fact that it is a non-exempt solution. The other key point is non-exempt. That doesn't sound good. Myself, in the past, when I was working with traditional insurance, something you wanted to avoid. The product, again, it is exclusively designed for charities and for donors. It is actually literally required that it be owned by a registered Canadian charity. The reason for that is non-exempt product. We needed to tie it to an entity that is exempt from taxation. That's the charity. So it is required that the charity is the owner. So the charity is the owner. They are in the driver's seat to make decisions around accessing cash. And we'll take a look at that in just a moment. But the ability to access cash, this is PAR, has the same ways of accessing cash as well. Conversations that I've had with charities and with associations as well is policy loans are available on this solution. So the ability to borrow is available. Also, we've had conversations with third-party lenders. So if you're wanting to take a bank, go to a particular financial institution, leverage the policy to generate cash flow, that's something that's desirable. Policy loans in particular were quite attractive because they were simple and they could be temporary. They wouldn't necessarily have an impact to the overall death benefit, but this product has the ability to access cash, and that's the charity that would be making that decision. One key point that we're going to take a look at, and this is kind of a bit of the difference when you're looking at MyPar Gift against our traditional products, are there's some tweaks that we would have ignored in the past. One of them being cash dividend option is quite attractive for a charity. Again, an entity that's exempt from tax. If we could pay out a dividend as cash to the charity on an annual basis to create additional liquidity for them, would that be attractive? The answer that we've heard loud and clear is absolutely. This sounds great, and it's a simpler solution as well. Death benefit as well would be paid out to the charity. Just to put some numbers to what we're talking about here, we're looking at a 50-year-old male non-smoker. For this, the donation amount's $100,000. Key point there, age range for this product is ages 18 to 75. It is available on single cases and joint cases. It also, the minimum donation amount is $10,000. So this isn't necessarily a product that's only available to the ultra high net worth and high net worth space. A donation of $10,000, you make that donation, it is scalable. The product is paid up at that point in time. But for simplicity's sake, we're saying they made a $100,000 donation. They will get a receipt for that because the charity owns the policy. The receipt is issued right away. So to get into the mechanics, Canada Life is working with the donor, also the insured, and the advisor. The product, the premium is paid actually to Canada Life for this example. If it's a cash donation, premium is paid to Canada Life. The owner is the charity. Canada Life would notify the charity that the premium has been paid. A receipt is issued out to the donor. Let's assume that they're at a 50% tax rate. They're going to get a tax credit of about 50 grand. So out of pocket, net about $50,000. Cash value for this example at year 20, $213,000 is available to the charity. That's the total cash value. Also, key point, the break-even point is year 8 for this example. So the point at which that $100,000, the cash value, equates to the $100,000 and continues to grow from there. The death benefit for this example at age 90, so 40 years into the future, is a $643,000. So you're seeing nearly a 6.5 multiple of the original donation that was made. And if you're to look at it on an after-tax basis, you're doubling that as well. So almost a 13 times multiplier. This is where charities get very excited about looking at this solution, especially when you consider the fact that it is single pay and it addresses those pain points as well. Other point to be made, common question that we get is charity ownership. What happens if the charity relationship falls apart between the donor and the charity over the next 40 years? There's different ways that this can be structured. So registered Canadian charity, one of the points that I'd make there, if the relationship was to break down, donor advised funds is a tool or a solution that can own MyPar Gift. So a donor advised fund, as I spoke to before, it is a registered Canadian charity. It gives donors more flexibility around how they want to distribute money. As an example, myself, I live in Kitchener right now. I'm from Winnipeg. If I was to move back to Winnipeg, but I originally donated to the Kitchener Community Foundation, and now I'm not in Kitchener. I don't have any ties here. I would have the ability through a donor advised fund to redirect that money towards something that is appropriate for me 20, 30, 40 years into the future, or even earlier than that. Donor advised funds can provide more flexibility, because a question that we get is, does somebody really want to tie this in for the next 40 years or for an extended period of time? There is a solution to that. That gives the donor more flexibility. In terms of ownership, it could be public charities, foundations, and private foundations, whether it be new contributions or existing assets. So there is flexibility there, a key point as well. Other key point, the life insurance, again, it's got cash value. It's an asset on the balance sheet of the organization as well. That's where charities get excited. So the idea of being able to leverage in the future is something for the more large charities. And this isn't what you would imagine. That is very much cash in, cash out type of charity. This would be the Sick Kids of the world, the larger hospitals, universities, larger charitable organizations. They were looking at leveraging strategies, and it is something that's of interest for them as well. Just to look at this example again, so this is that 50-year-old male non-smoker, same thing. Where there's a slight tweak on the original conversation is, number one, it's showing the internal rate of return for this example. This is for the individual at 50, $643,000. We spoke to that already. For a joint contract, you're going to get a lift as a result. So the two 50-year-olds will give you an equivalent age of about a 41-year-old, gives you an extra $106,000 40 years into the future for death benefit. Again, we understand joint contracts. Again, the call I just came off, joint was something that was attractive for them because their particular donor base was later on in their life. So joint contracts are available too. And there's even some flexibility around relationship between the donor and the insured. If they're within that first level of family, grandparent, adult child, there is opportunities there if you have uninsurable individuals, but joint is something that can be quite attractive. But for this, on a joint basis, charities speak to the ability to multiply the original donation. For joint, you're getting about a 7.5x multiplier on the original donation. I'll give you a bit of story of what this slide's looking at here. Again, this is that 50-year-old male non-smoker. Where it's slightly different than the other example is you'll notice that there's that plateau. So this is looking at an enhancement coverage. So again, I spoke to at the beginning of the call, ways to design product that aren't traditionally used in the ultra high net worth space. To give you an example, when I was out in Vancouver a few weeks ago, we were having conversations with charities. One in particular, a university out in the West Coast, had a donor looking at making a significant contribution. The example on the screen is $100,000. This was larger. This was $3 million that they were looking at donating. The reason they were having a conversation with us is, how can they design a solution where from day one, they needed to hit at least a $10 million threshold to give this individual additional recognition. The recognition they wanted was essentially to get their name on a building. So how could they design a $3 million gift to give that guaranteed death benefit locked in at 10 million plus? The example that we ran, now this was for a 50-year-old joint case, we were able to achieve with $3 million, $11.5 million of death benefit from day one. So we were able to achieve that recognition that they were looking for. And this is a case that we're actively working on right now, working with the advisor and working with the charity as well. So again, all of that's to say it's scalable. The example on the screen is a $100,000 donation, the same one that we had before. The big difference is the guaranteed death benefit on the PUA example from day one was $161,000. For this, the guaranteed death benefit is $262,000. So for those, and this is all a bit of an objective conversation, what is the overall goal with the MyBar gift, or what is the goal for this gift that the individual is going to be providing to the charity? If the goal is to maximize death benefit from day one, enhancement can be a very viable option. The other key point to put your eyes on the screen is the trade-off in death benefit at life expectancy. On the previous slide, it was $643,000 at age 90. This is $632,000. So about 10 grand of a difference between the two to give considerably more death benefit from day one. It's not to say that this is the solution for everybody. It's really objective based for you when you're meeting with your clients and meeting with the charities. What are we trying to achieve? Enhancement can provide a lot of flexibility. It's something that, again, charities have found quite attractive, whether it be the $3 million policy or $100,000 or $10,000. So it's another option that's on the shelf for you. Here's another example, and I believe I spoke to it earlier on, cash dividend options. So this is that same example, 50-year-old male non-smoker, $100,000 donation. From day one, guaranteed death benefits, $161,000. What we're showing here is, again, the ownership of the policy is an entity that's exempt from taxation. We're going to issue a check to the charity on an annual basis for that dividend in cash. They'll be able to cash it out, and they'll be able to realize that cash flow while the insured is still alive. And this can be something that's still quite attractive for the donor and also for the charity. Where they like it is the simplicity. It's literally flipping the switch from PUAs to cash dividend. One thing to keep in mind is once you've switched that switch down to cash, to go back to paid up additions, there's additional underwriting requirements. But for the example that we have on the screen here, we're showing from day one they switched to cash dividends because that was the objective that they wanted to achieve. So to summarize this example, it's a $100,000 donation. They're going to get the tax receipt for the $100,000. This is going to save about 50 grand as a tax credit. The cash value break even is about year 9 when you take into account the cumulative cash. But $100,000 in, $162,000 guaranteed, or $161,000 guaranteed death benefit at age 90 or at day 1. And the cumulative cash value or cash that's paid out from dividends between now and 40 years into the future is $162,000. So this is something that is quite attractive for charities, whether they be smaller charities or larger charities. Larger charities generally are going to focus more on the PUA option. But again, all that's to say, this is something that we haven't looked at before. Traditionally, when you're speaking to ultra high net worth clients, cash dividend can be a viable option to give the gift while the individual is still alive, but also the gift on death as well. To step through product, where the differences are, number one, I spoke to this, and this is a unique aspect. This product is designed to be non-exempt, so it's specifically tailored to that. It is literally a single premium payment. So the green text on the screen is what differs from what's on the left-hand side of the screen. It has one single cash value pattern. There is no MyPar gift early value product, MyPar gift delayed value. It is one product for all. And there's a cash. This kind of hits the best of both worlds because you're putting so much in at a very quick period of time. You have a fantastic cash story earlier on, but also you're seeing death benefits that, as I said earlier on, exceed our existing products that are on our shelf. For dividend options, I illustrated these already, but PUA enhancement coverage, it's a lifetime guarantee on that. And cash dividend is also available. I spoke to single and joint, ages 18 to 75, and the minimum donation amount is $10,000. The other key point, if you remember those pillars that I spoke to earlier on, are simplicity. So we've cut out a lot of the added fat or added bells and whistles on the product. There are no riders and additional benefits that are available on this. There is no additional deposit option that's available. For eco or enhancement coverage option, it's literally lifetime guarantee. That's the only option that's available. Offsets and RPUs are not available on this. It's literally a paid up contract after that single deposit is made. And I did speak to also policy loans are available. And also the ways to access cash are the same as they are with traditional products too. Another question that we get, and this came up in the 2 years of examination with advisors, was fantastic, you have a very competitive product. How does it compare on a compensation basis? And as you can see on the screen, from a dollars perspective, now we're looking at same $100,000, 50-year-old male non-smoker on the left. And then we're splitting out that same, and this is the difference or change in dynamic. We're using the same cumulative pot of money, but we're spreading it out in our 10 pay. So we take $10,000 a year into the 10 pay, 20 pay, it's $5,000 a year. And then the life pay, it's $2,000 per year. So for the percentage, you'll see a lower percentage amount, 4% versus the higher ones for the other examples. But what you got to realize is the fact that you're squishing all of that money into a single deposit. That full pot gets squished down into a single year. So it's a smaller percentage of a much, much bigger number, which drives from a dollars basis. And we're assuming a 200% bonus rate. So adjust that as you see fit. But for this, $12,000 would be the compensation on that $100,000 donation for the advisor. So that, and what the green cell is on this table is the highest number for a particular row. So from a dollars perspective for HEAP commission, this is the highest compensation for our product shelf. From a trailer's perspective, this is a paid up contract after that single deposit is made. So there are no trailer commissions on this. So that's where it differs from the other products. You'll see that's where there's additional cash flow that's coming in from trailer commissions. And you'll see from a total compensation perspective that MyPar gift still continues to be very competitive versus what's shown on the screen here today. So we have an attractive proposition from a compensation perspective as well. Other key point here is that from a chargeback schedule, there's a 2-year chargeback on this. And the key point to take away on this is the cash value pattern. I spoke to year 8 is that cumulative cash value or the break-even point. conversations with charities, there is no incentive for policies to lapse in the early years. So the 2-year chargeback is really to harmonize our existing shelf, but it's also, there is no incentive for a charity to cash out a product prematurely in order to lapse it and get access to the cash. The cash design is just not as attractive for them until after that 2-year period. So from a value proposition perspective, before I step into tax rulings, is from an advisor's perspective, or actually just overall, we have a simple tailored solution for charitable giving. The experience piece being tailored. One of the key points that we heard loud and clear going back probably about 10 slides was financial underwriting is a headache for these products, for traditional insurance, particularly with having to show a history of gifting to a particular charity. With My Par Gift, it has unique rules, and that the single act of saying that you're wanting to donate a My Par Gift because it's a single premium, that satisfies. There isn't a need to justify past history of gifting, so that's addressed. Normally, you'd have to justify that you're able to fund premiums over an extended period of time. Again, the change in dynamic, the fact the product is paid up after that single deposit overcomes that challenge. So from a financial underwriting perspective, simply by changing it to a single pay product has addressed a lot of those pain points that exist with traditional insurance. And another point that I'll make here is, again, great traction, great excitement around My Par Gift. It's not to say that this is the end all and be all solution for all planned gifts. Traditional insurance has its place for those that are looking for tax receipting in the future on death, where the charity is the beneficiary. This is a new tool or a new tool on the tool belt. But where we get excited is from a donor's perspective or from a charity's perspective is the fact we have a new conversation to speak to insurance in the charitable space. But for advisors, as I said, illustrated values are very strong relative to our existing shelf. And also when you compare it to competitors' offerings as well, we have a great death benefit and cash value comparison. I spoke to the competitive compensation that's available to it and the fact that it is a fully paid up at issue as well. And the other key point is the change in dynamics is Canada Life then is responsible for the ongoing servicing of the policy. And that's where we've made considerable efforts around how do we streamline that servicing experience for the charity. So we have resources that are specifically tailored to charities, recognizing they're not insurance specialists. But number one issue that we hear is that pain point. When charities are contacting us, it's typically around premiums being required or questions around ongoing premiums. The single pay addresses that head on. There is no concern with ongoing premiums, but there are resources that are available. We have a website that's actually dedicated, and I can send this out to the IDC group to send along to this group. There's a website that's dedicated to charities wanting to get more information about My Par Gift and to have resources available to them to help them through this process as well. The other piece, when we're speaking with charities, is very much to keep open dialogue with them. We're looking to provide that white glove service, and that's even our commitment to you too. If you are looking at considerable cases with this is a new product. We very much, myself and the working group, want to be connected to those solutions and your regional wholesalers as well. So please keep us connected. Any feedback that you have, please feel free to forward it to myself or to your wholesaler, who will filter it to myself or to the working group. From a charity's perspective, though, the number one is the ability to increase donations, but also the fact that they are in control of the policy. They like to, there aren't any surprises. Again, another piece of feedback that we received is a lot of donated gifts, especially with insurance, are surprises, or they were a bit of a blind spot for them. They didn't know that this was going to happen. For this, the fact that they are the owner, they do know. A question that we get commonly is death benefit. That can be quite challenging. The example we looked at, 50-year-old, 40 years into the future, death claims can be a bit of a sensitive topic, as you can appreciate. One key point to keep in mind, the way that the cash value works for well, as you know, for PAR, at age 100, they do merge. So the cash value and death benefit equate to each other. A point that a question that we've had from charities is, this is a challenging point. How can we make this easier? So we're making efforts around including inserts for policies. So there are amendments or notes that are added to wills to make it a bit of a more positive experience. Another point for charities, though, is the little bit of compromise in death benefit. If they were to look at cashing out the policy closer to mortality, if it's an age 90 plus, it's going to be a small trade-off for a lot easier of a conversation to get the cash out of the product. So just simply lapsing the policy at that point in time is something that they said is quite attractive for them as well. For donors, it is single pay, one and done financial commitment. the ability for immediate tax benefits, which we're going to touch on in a moment, but also donation has the opportunity to grow. So whether it be paid up additions to help to grow those benefits as well, but also to provide flexibility when working with the advisor around what is my objective and be able to design a solution around that meets the needs of the charity and also of the donor for the gift. But let's just take a bit of a sidestep, and then we're going to look at a few case studies. But tax rules and charitable donations, because there's some interesting points on ways that you can structure most efficiently gifting money, whether it be cash or appreciated securities, that can enhance the conversation around my par gift or just insurance in general when you're gifting. And that's really around the premium structure. So for this, we're looking at a few different options on here in ways that this is a bit unique. So individuals can donate to a registered Canadian charity, either cash or marketable securities. And again, the My Par gift payer can be either the individual, or if it is structured for marketable securities, and maybe I'll take a bit of step back just so you know exactly what I'm looking at for that. So that's the donation of appreciated shares. So if you could imagine you had public shares, you bought at a certain amount, they've grown to a certain level. If you're to donate those shares directly to the charity, the capital gain, the difference between the market value and the cost base, you're not having to actually incur that capital gain by donating those shares directly. So for My Par gift, you have the ability to take advantage of that. So transfer those shares to the charity, they can liquidate them. The individual is not having to pay the capital gain on that particular donation, which helps to reduce the tax burden of the donation, and also helps to indirectly reduce the actual out-of-pocket cost for the donation as well. So that can be done on both an individual's basis, and where we get quite excited for this is also corporations can use whether it be cash in the corporation, or if it is appreciated securities that are held at the corporate level, those can be donated as well, because there's actually a benefit to CDA as a result of a donation of marketable securities to the charity. And I'm going to touch on that. We'll look at an example actually at the end of this call that will look at that in comparison to cash. But all of this is to say the traditional ways of gifting money to the charity are available for this solution, and to use those funds to fund it as well. And there is opportunities to really sweeten the story or to supercharge the story around My Par gift too. Tax considerations for gifting public shares. So that's that example that I spoke to. You have a certain amount of assets. They've grown to a certain level. They grow, not having to pay tax on the capital gain. So the capital gain inclusion rate for an individual or for a corporation, and actually just because I remember I didn't touch on that on the previous slide, for corporations, we're looking for the controlling shareholder to be the donor or to be the insured for this solution. So that's a key point to keep in mind. But in both cases, the capital gains inclusion rate is 0. The non-taxable portion, and this is a key point for corporations, that's the CDA piece. So for an example that we're going to look at, I believe it's $500,000 is the market value of the investments. Let's just say for now, the number will change slightly, but the cost basis was $300,000. So the $200,000 gain, the full amount of that unrealized gain actually can be credited to the CDA account of the corporation. So again, an added tax benefit too. So we'll look at that in just a moment, but something to keep in mind for corporate examples. For tax benefits for individuals, they receive a non-refundable tax credit for the value of the shares in both examples as well. Another key point is the income tax is generally reduced by approximately 50% of the amount of the donation, depending on the province or the amount that was donated. For an individual, for corporations, it reduces the taxable income by the full amount of the donation. So key points to keep in mind there. But what we're going to do, that addresses some of the tax considerations, and we're going to look at that. How do we apply it actually to a situation for clients? And one of those being with Sam and Sonia. So I have two examples that we're going to look at. The corporate one, as you can appreciate, is slightly more complicated because we're going to be looking at donated and appreciated securities, go through some numbers there. For Sam and Sonia, they're an individual couple, and we're going to look at really how can My Par gift help to benefit them and provide more opportunities to enhance their donations. So for Sam and Sonia, they're both standard non-smokers. They recently moved to downsize their home and have a significant amount of cash. So Sam and Sonia, and again, this is an important point. not every client is suddenly going to be philanthropic in nature, but Sam and Sonia have a relationship with their favorite charity, and they're looking at ways to gift $100,000. How could they maximize that gift, but also provide some flexibility for them as well? So they connected with their charity and their advisor, and favorite charity to discuss what options could meet their needs. So it's not necessarily a my par gift. We're obviously going to look at that in the case study, but a conversation of what are we looking to achieve. They had a significant liquidity event right now, and they're looking at, okay, how can we transfer the most over, but also provide tax benefits for them as well. So after Sam and Sonia meet with the charity and decide that the insurance achieves their needs best, and that's an important point. And I said that earlier on, but I'm going to touch on that just one more time because it's a common question that we get in my experience working with advisors, working with charities, is when are charities involved in the sales process? They are involved fully. So there would be a conversation between the advisor, Sam and Sonia, around what are we looking to achieve here? But the charity being the owner of My Par Gift, they would absolutely be connected to the conversation around what are we looking to achieve with this gift? They would also be connected to the application process because they are the owner as well. So this isn't something, as I spoke to, surprises for the charity. They're fully aware, fully connected to this, and they're a part of that conversation that is touched on with the advisor. And that's a key point. As I spoke to compensation before, there is considerable amount of effort that would go into the setting up this arrangement. So that's why we wanted to make sure that there was competitive compensation for the advisor. But it's a bit of an aside, but I just wanted to make sure that that comment is clear because I've repeatedly gotten questions around when do the charities get involved? And I'd say very early on in the sales process, they're part of the application as well. Okay, so after comparing insurance solutions with their advisor and the charity, all the parties, they mutually decide they like the idea of the one and done financial commitment. They like the growth pattern of the solution. My Par Gift is really the solution that meets their needs best. So again, single premium, immediate enhancement. They like the idea of the enhancement from really day one and the opportunity for growth. But they also like the idea that the charity has the flexibility to access some of that cash earlier on. But they also want to make sure that this isn't a burden. So that really covers a burden to the charity. And there's no premium risk that is for the charity. It's, again, that one and done. It is literally paid up after that single deposit is made. So let's take a look at the actual case study for them. So Sam and Sonia, if you remember, they're 60-year-olds. Joint last to die is what we're looking at here. The single deposit that we're looking at, our donation is $100,000. Again, for simplicity's sake, they're going to get about $50,000 as a tax credit for themselves as an individual. The base coverage for this example, it's $155,000, and we're looking at paid up additions. Again, that their objective is to maximize growth, as we said earlier on. They could look at the other options we spoke to earlier as well. So from a death benefit cash value perspective for Sam and Sonia, again, we're looking at 40 years into the future, or actually, sorry, 30 years into the future because they're two 60-year-olds. So death benefit is $424,000 for this example, or an internal rate of return of 4.94%. And that's a key point. So when I've had conversations with charities around rates of return, again, they're an entity that's exempt from taxation. They're not looking at taking on, and these are the major charities. We're not talking about smaller charities that are very much sensitive to risk, but larger charities as well are not looking at taking on considerable volatility and risk. So a 4.5% to 5%, depending on what you're looking at, with our recent dividend scale increase 25 basis points, it's amazing to see how much illustrated values, specifically with My Par Gift, have increased as a result of that increase in our dividend scale. But for this, 4.94%, very attractive from a charity's perspective. The other point is from a cash value point, and that's where Sam and Sonia were very adamant that they wanted to have liquidity as well available to the charity, a crossover at year 8 too. So an attractive proposition for them, an attractive internal rate of return, but also the idea of being able to take on an after-tax basis nearly over an 8 times multiplier of their original donation. And really that's the way that the specialists in the space will speak to how do we amplify that gift. This is a solution for Sam and Sonia. So I know I'm running out of time, and I see that there might be a few questions that are in the chat. So I'm going to step through one other example with Jim. So this is that donation of appreciated public shares. So Jim's 52. He has a holding company, Jimco, that recently sold some business assets. So again, a liquidity event, tax planning, also philanthropic. We're assuming his tax rate's 50%. But again, he's a philanthropic client. So he's not suddenly going to become a philanthropist, or maybe he may, but Again, it's not to suddenly say that all individuals are going to suddenly be focused on social good or charitable giving, but for Jim, he is. So let's take a look at an example. So Jim Co, he's looking to make a $500,000 charitable donation to Jim's favorite charity using a portion of his investment portfolio. Market value, and this is key, $500,000, and that's going to solve for the premium for the MyPar gift. Cost base is $300,000, and then the accrued gain of $200,000. So what we're going to look at is ways that Jim could use this money to transfer it over to the charity, and how can we do it most efficiently. So a lot of numbers on the screen here. I'll kind of draw your eyes to a couple. Very top, that A, as you'll see there. So option 1 is selling the shares today, donating cash. Option 2 is donating the shares directly. And we're illustrating at the bottom of the screen the efficiency of donating those shares to the charity and then using the proceeds to fund the product as well. So we talked to the cost basis, the capital gain on it, it's $200,000. For selling the shares today, donating the cash, the taxable portion of that capital gain would be $100,000. So the actual tax would be 50 grand that they would be paying. That's what it's showing on the screen here. For this, the unrealized portion that is credited to the CDA account for the selling of shares and donating cash, it's $100,000. But the value of that CDA to the shareholder, assuming a 45% tax rate, it's about 45 grand. Spoke to the capital gain of $50,000, and then that the deduction that they would get as a result of that donation of $250,000. So all that nets out is to the cost of donating those shares, of liquidating the shares and donating cash is $255,000 versus option 2, the more efficient option. You donate the shares, market value of $500,000, same cost basis, same capital gain. Where the differences are, the zeros that you're seeing on the screen. Taxable portion of capital gain, you avoid that by donating directly. There's no tax that's being paid. The addition to CDA is double what it was on the other because the unrealized gain is the full $200,000. So that's the credit that's being added to CDA. 45% of that drives the $90,000 that you're seeing on the screen. Again, the tax receipt that you're getting or the deduction is $250,000. So the net out of pocket for donating, and I know I went through these numbers quite quickly, but you will have access to this presentation, is $160,000. So the more efficient option to drive the donation is the donation of shares directly. And as I said, we can use that as a funding source for MyPar gift. So remember that $160,000 number. So for this, we're looking at the donation. So we're using the market value as the single premium. That's the $500,000. Jim, individual, so single life. That $500,000 from day one will lock in at $803,000 of base coverage. Again, Jim's focused on maximizing the death benefit as well. But again, remember the $160,000. So for this example, we're looking at Jim Co at age 90. It drives just under $3 million of death benefit, an IRR of 4.83%. But when you take into account, and this one, the IRR isn't taking into account the lower amount that's being used to fund it, but $160,000, if you think about it, $160,000 donation out of pocket cost to get a $3 million death benefit. For Jim, does that seem like something that would be of interest to you to enhance the benefit, also to provide a bit of that one and done financial commitment, and also to provide that tax receipting for him because he had that significant liquidity event? So again, a really attractive value proposition. This case in particular has resulted in additional conversations with other cases that we're working through right now. But also from a cash perspective is year 7 and year 8 is generally where that crossover point is for cash value. So that's when the cumulative cash value surpasses $500,000 for this example. But again, $160,000 to drive a nearly $3 million death benefit for Jim Co for the charity of his choice is something that was quite attractive for him from a corporate basis. So where we really get cited is really the opportunities for I know for this group, working the ultra high net worth space, generally large premium comes from corporate dollars, and this is something that is available as well through MyPar gift. One last piece before I get to the value proposition and to questions, I know we only have about 8 minutes, is there are a number of resources that are available. I spoke to one that I will send out to this group, or that we will send out to this group, but one of them is an advisor learning video. It's basically an 8-minute video to go through all of this that I've gone through in a really condensed method. But very much useful. It also runs through the application process and some more details around the onboarding experience. The other piece, and I'll draw your eye to one point, but there is a support resource that's available, recognizing that this is a unique product. One of the key aspects is the fact that it is a non-exempt product, which requires anti-money laundering requirements. You can see that on the screen there. So there's added information. We wanted to make sure when we launched this that we had a resource that's available to you to say, here's the forms that need to be completed. Here's the steps that have to be done. So we don't want you to become a process specialist. We wanted to have a resource that's available to you to support your discussions with charities and with donors. And as I said, we're looking for feedback from you. And if you have significant cases or questions that you're having that are you're running into, I'm sure a number of regional wholesalers are on the line right now that are available to support your questions, but also to have that open feedback loop with us. We very much are taking a white glove approach towards this launch. We're building a lot of excitement around the solution. We want to make sure it's as positive as possible. Last slide, just to summarize, and then we'll jump into questions, is 5 key takeaways for MyPar Gift is number one, it's a unique offering in the charitable space. It is unique in the charitable space, and it is only available at Canada Life. The simplified value proposition, it is a single pay product. It is paid up after that single donation is made. Tax receipting happens right away. I spoke to attractive compensation, recognizing that there's tremendous effort between the charity, the advisor, and the donor to set up these designs. We went through a couple case studies quite quickly, but it is a collaborative process between those 3 parties to get a policy put in force. We wanted to make sure that the compensation reflects that. As I spoke to, from a dollars perspective, the highest compensation versus our existing shelf for those examples that we looked at. The other piece was product's great, experience needs to be aligned with a positive experience or tailored experience needs to be provided as well. And I spoke to some of the points that we have. Again, it's an ongoing conversation. We feel strongly that we have a great value proposition from a servicing perspective. As we've all experienced, there will be opportunities to do more, and that's where we're committed. We're not just launching and forgetting about this. This is a product that we have a roadmap of the next year, 2 years of what does this look like as well. So it is something that we're looking for feedback from this group. And as I said, reach out to your regional wholesalers if you have any feedback that can help us to make that experience more positive. And just the last point is the fact that this is a very competitive solution. I spoke to the comparisons, run the numbers against competitors, and you'll see for a design like we were looking at, competitors don't have a single pay product, but if you spread out the premium over a longer period of time to generate kind of the same example, you'll see the benefits of MyPar Gift as well. No. I have only 5 minutes for questions, Denton, but
so we got a couple questions, if you don't mind.
Yeah, for sure.
Time. Who's the life insured? Can you confirm who life insured is? Does it have to be the donor of the fund of the to the charity?
It doesn't necessarily have to be the donor. That's a common question. So as I spoke to, depending if it's an individual, it has to be in kind of that first line of family. So it's grandparent, parent, or adult child. So the donor could differ from the insured. Also in corporate circumstances, again, if it's the money coming from corporate dollars, if they are not the controlling shareholder, there's a bit of flexibility there around who could be the donor and who the insured would be. But yes, so there is, and that's what I was speaking to before, Nitin, around if you have an individual that maybe isn't insurable, there's an opportunity for grandparent, maybe could insure a child, or kind of like a cascading strategy that we would be familiar with.
Got it. Okay. Yeah. No, that's great. And then if there is a taxable event at some point in the future on a non-exempt product, who gets the tax bill? Is it the charity or is it the donor?
It would be the charity. So the charity is the owner. So we will actually still issue T5s out to the charity. And another question that we get is, what if they lose their registered Canadian charity status? We still issue out T5s. All that we require is at the point of issue that the charity is considered to be a registered Canadian charity in the eyes of CRA. If they lose that status, then they would receive those tax slips and they would have to file taxes for them.
Okay, great. And the next question is actually one that some people have asked me in my current role as well. Has there been a CRA tax ruling on this product?
There hasn't, no. So for us, we've worked really closely within our own walls with our legal team, also our product taxation group. And we feel strongly that there isn't any sort of sensitivity around what we're designing here. This is a product designed specifically around charitable good. The one key piece that we have where our comfort level is that it must be owned by that registered Canadian charity. Because a common question we get is, well, why don't you start developing non-exempt products for individuals? And that's not what's happening here. It is just for registered Canadian charities.
Okay, no, great. Another question here about the 4.94% that you talked about. Is that a guaranteed 4.94%?
It's not a guaranteed 4.94%. No. So this is par. So this is using our current scale, which just increased to 5.5% or DSIR. But as you can experience, you can show reduced. We were looking at current scale, but it's not guaranteed that it would be there. There is guaranteed death benefit and all of that, but it's not a guaranteed 4.94%. No.
Right. So if the div scale changes, that will affect your eyes.
That's exactly it. Yeah.
You go up or down. Those.
Exactly. Yeah. And the last 2 years we've gone up. So yeah.
Okay. And when is the tax receipt issued by the charity?
It's a good question. So once we notify them that the premium's been paid, again, a common question that we'll get is a lot of people like to donate right before Christmas, right before the end of the year. What if they need that tax receipt to hit in 2023? Our recommendation is donate directly to the charity. We'll do our underwriting on our end, but the tax receipt is issued by the charity once they receive the donation. So that's kind of the way that it would happen. But it's basically once they've received notification that the donation's been made.
Okay. Another question that I've gotten as well, and
sure.
It's any restrictions on the charity? Is it private church or does it have to be a public charity?
As long as they're considered, if they're in the eyes of CRA, a registered Canadian charity, so that's private foundations, in some cases, as I said, donor advised funds. So as long as they have that registration number that's available, then they are able to own this product.
Okay, great. A couple more questions here.
Sure.
We've got a couple minutes here. So
sorry.
Are US marketable securities also acceptable as a contribution?
U.S. marketable security, that's a great question. I actually haven't had that one. So let me take that one away to see if that is something that would be acceptable. From my understanding, it's really public shares held in Canada. But I can confirm that. And I'm assuming there's a mechanism for us to reach out to either the individual or just to send a note out to everybody. But
okay. Oh, that's great. And then got a couple more, like who is our Canada Life regional representative? I believe that's something that you can reach out to your BDE at IDC. They can put you in contact. We've got advisors coast to coast here. So, and then there's medical and financial for underwriting, I guess, on the donor, even if the life insured is a child. Like what sort of underwriting is required if you're a donor, if your life insured is a child?
Again, they have to be an adult child, so they have to be between 18 and 75, but it would follow it's the same medical underwriting process or financial underwriting that we would deal with right now. So there really isn't any differences between this and our traditional products. It's the exact same experience for that. Financial underwriting, that there's a couple tweaks where traditionally gifting to charities, you had to show a past history. For this product, because of single pay, you don't have to show that, but yeah.
Okay, and letting off with one last question is, where can we get the illustration? How can advisors illustrate?
That's a fantastic question. Yeah, and actually there's been news on that recently. So we have a solution called Advisor Workspace, which is basically our advisor portal that you can log into. The illustrations are only available on our web illustration software. So registration, I believe, as of the end of last month, and I'll work with our national account partners to send you, again, just to make sure that you have that information, but you're able to register today to get access to illustrations, but it is on the web platform.
Okay. No, that sounds great. So we are a little bit over time.
Sorry about that.
I'm not sure if you mentioned it before, but who can we contact for any additional questions that we may not have gotten to today? Or
absolutely. As I said, I would recommend, as you said, Nitin, if it's your BDE, to connect you to your regional wholesalers. They are our boots on the ground support for this. But also, if there is feedback, if you're working on a case, you're needing support, regional wholesale, but they're also connected to myself and others that are in the working group that developed this solution. We are very much, again, I'll reiterate, white glove approach. We want to make sure this is as positive an experience as possible. If it's a larger premium case, like that $3 million example that I was speaking about, we're all over that. So the regional wholesaler support is there to support you, and then we're also at head office able to help you through this process.
No, that sounds great. Thank you so much, Evan, for taking your time and speaking to us today. Thank you for all the attendees today. Hope you guys have learned something. Again, feel free to reach out to your wholesaler, myself, Evan, and we will be happy to answer any other questions. So thanks, guys, and enjoy the rest of your day.
Thank you so much.
All right.
Bye-bye.